Welcome back to Managerial Finance. I'm Dr. E. I'll be your host for the episode today that covers profitability ratios. Profitability, I would say the single most important dimension of a business. How lucrative is the business? Profitability. Analysts pay very close attention to profitability. Let's check out this marker, see how it's working. Boom, and it's working pretty well. All right, so let's launch right into the discussion about profitability. What three things, so this is homework 5, chapter 3, homework 5. What three things affect the gross profit margin percentage? First, pricing. Understand that in a market economy, pricing needs to be competitive. There are ways to get a higher price, typically if you provide some type of higher service, a nicer environment, maybe a product that has added features, but pricing is really important. And then sourcing the product, the cost of the product. It's really important to have a low-cost product that gives you more room to maneuver with your pricing. So that's cost of goods sold. And then lastly, product mix. What types of products do you sell and what do the margins look like on each of those products? Why is the gross profit margin important? The gross profit margin is important because it determines how many dollars are available to cover a company's expenses. So in order to generate gross profit dollars, you have to sell a combination of items that have a high gross profit and a large number of units. And when you are selling products or services, the more gross profit you can generate, the more money is available to pay the rest of your operating expenses. Speaking of operating expenses, question 3, what two things affect operating margin? SG&A expenses and depreciation. All right, what is depreciation related to? Well, it's related primarily to the amount you spend on property, plant, and equipment. So how much money you spend and what type of property, plant, and equipment you buy, because your depreciation schedule depends on what type of property, plant, and equipment you have. What two things affect net profit margin percentage? Interest expense and taxes. Sometimes you'll see other expense or non-recurring expense thrown in there as well. But the two major items that distinguish operating profit and net profit margin, interest expense and your taxes. Question 6, how do you calculate the dollar amount of interest expense? It is interest rate times the principal owed. The principal is how much you borrowed and how much you still owe. Question 7, is it better to have high or rising margins or low declining margins? High or rising margins are much better. They imply rising cash flow for the company, improving financial strength at the company, and also better management. So there are lots of reasons why your margins might be high or rising. They include your competitive situation, they include your sourcing, the cost of your goods, they include your product mix, they include how carefully you control your SG&A expenses and your depreciation. They include how much interest expense and what your tax rate looks like. Okay, so there are a lot of things that go into your margins. The better you manage your company, the lower your cost of goods sold, the higher the price that you can charge, the better off your company is. All right, list the formulas for the following three profitability ratios. So gross profit margin percentage, GPM percentage equals sales minus cost of goods sold divided by sales, or gross profit divided by sales. All right, operating profit margin percentage is equal to EBIT divided by sales. Net profit margin percentage is equal to net income divided by sales. Okay? So up here, you've got pricing, cost of goods sold, and mix. Here, you've got SG&A expense and depreciation. And here, you've got interest expense and your taxes. Okay? Be mindful, you are business students. I don't care what area of business that you are interested in or that you will get involved in, you need to understand this. Okay? This will help you contribute to your company. It'll help you be a better employee. It'll help make you more impressive in an interview and at your company. It will help you in your career. All right, so let's do some calculations. So let's do 2017 and 2016. And we'll do GPM percentage, OPM percentage, and NPM percentage. All right, so for 2017, we've got gross profit. They call it gross operating profit. This is the ITT Corp. It's not gross operating profit. It's gross profit. So that's going to be $24.96, which is your gross profit divided by 67.64. Okay. Then in 2016, you've got 21.31 divided by 56.27. I'm rounding just a little bit. Okay? So let's get our calculators out, clear them out. Second future value, second CEC and CEC, and we got 24.96 divided by 67.64, and we have 36.9%. And then we have 21.31 divided by 56.27, and we have 37.87%. Now I'll let you do 15 and 14 on your own. All right, let's do operating profit margin. So that's going to be EBIT, 673. Again, I'm rounding just slightly, divided by 67.64. And it is 559 divided by 56.27. And let's calculate that out. 673 divided by 67.64 is 9.95%. And 559 divided by 56.27 is 9.93%. So not a lot of movement there. And so you might look at this one and say, okay, we've gone from 37.87% to 36.9%, and you might not think that that is a big change. But let's say this, 0.3787 minus 0.369 is 0.0097. Walmart last year did $550 billion. Let's see if my calculator will even do that. Times 550. No, it won't even do that. So that's 53 billion. Won't go that high. Let's see, what is that? Well, that's 53 million, but we're going to have to add on to that So that's a $500 million in profit. Going from here to here for Walmart, not for this company, but for Walmart, that's a $500 million in profit. That is gone, vanished right here because they couldn't maintain their gross profit margin percentage. Don't ever underestimate how important it is to maintain your gross profit margin percentage. All right, net profit margin. So that's going to be net income, which is, we'll call that 438, divided by 6764, and net income of 391 divided by 5627. Okay, see where those numbers are coming from? Net income divided by sales. So 438 divided by 6764 is 6.48%. And 391 divided by 5627 is 6.95%. Okay, so the companies, it's interesting. Let's double check the operating profit margin percentage again. 672.6 divided by 67.64, 9.95. Okay, and 559 divided by 56, 26.6, 9.94. Yeah, that's interesting. Gross profit margin went down. They were able to maintain, so they must have cut a little bit of either depreciation or SG&A in response to their lower gross profit margin, and that enabled them. But then something, either tax rate went up or interest expense went up, and look at on their income statement, their interest expense went from 20.9 to 50.4. So that's caused the deterioration in their net profit margin percentage. So I just taught you something. What you do, first you do your calculation. Then you make your observations. What's going on? Then you look for explanations. Calculations, observations, explanations. What explains why these numbers are doing what they're doing? And you can see it in the financial statements. Then you go back to management and say, why did your interest expense go up? Well, we said earlier that interest expense is interest rate times principal owed. So we don't have the information. We go into our financial statements, the notes of the financial statements, and we could see possibly what interest rate they're paying, but would have to go to the balance sheet, which I don't have in front of me, to see if the principal owed went up. So it was either a rate increase or the principal owed went up. Let's look at depreciation, and our depreciation went up, which indicates that they might have added to their assets. Why did I look at that? Well, why do you borrow money? Well, the main reason you borrow money is to buy property, plant, and equipment. And if you buy property, plant, and equipment, then your depreciation expense goes up. So you see, as an analyst, you start connecting the dots, and that's really, really important. All right, let's take a break, and that's Chapter 3, Homework 5, and we'll come back and look at Chapter 3, Homework 6. Peace out. Shalom.